Afternoon and welcome to today's webinar, Leveraging Small Multifamily Loans in 2017, How to Grow Your Multifamily Investment Portfolio and Maximize Returns. I'm Sam Chan and I'll be moderating today. I'm the Silverstein Chair in Real Estate Investment and Development at NYU's Schack Institute of Real Estate. Before I introduce today's speakers, a few housekeeping items. First, this webinar is being recorded and the recording will be emailed to all attendees later this week. It'll also be available at arborloanexpress.com. We'll also have time for a quick Q&A after the presentation, so please submit any questions you have using the Questions tab on your webinar control panel, and you can do that at any time during today's presentation. If we're unable to get to your question, just give us a call or shoot us an email, and with that, we will get started. My panelists today are Ivan Kaufman. Ivan is founder, chairman, and CEO of Arbor Realty Trust, a publicly traded commercial real estate finance investment company. Mr. Kaufman is also principal at AMAC, a national real estate investment firm, and co-founder and CEO of Arbor Crowd, an online commercial real estate investment platform. Steve Johnson leads Freddie Mac's multifamily small balance loan business unit and manages all aspects of the company's small loan programs, which last year funded more than $2.5 billion in small balance multifamily lending. We're going to begin with a brief discussion of what is a small balance loan, to provide some background for folks who might be new to this space. And I think what we need to do first is essentially define what qualifies as a small balance loan in the multifamily space, not a dictionary definition. Although small multifamily properties are commonly defined as those with 5 to 50 units, Freddie Mac has recently announced a new small balance loan program that is designed for a specific class of loans in terms of the balances at origination. Multifamily loans ranging from $1 to $6 million in all markets across the country. That includes properties with 5 or more units, and multifamily loans also from $6 to $7.5 million in the top and standard markets for properties with 75 units or less. In terms of the size of this market, if we take a look at the next slide, what you can see in this pie chart is that in terms of the number of loans that are originated in the multifamily space, small balance accounts for an overwhelming majority of multifamily lending activity. And you can see here when we define it as $3 million or less, so the very low end of that small balance range, in 2015 we were talking about 63% of the multifamily loans. When we include sort of the next tranche from $3 to $10 million, which goes just a little bit above the cutoff for small balance lending, we're looking at another 23% of all of the loans. So it's a relatively smaller share of the overall balance of loans outstanding, but it certainly accounts for most of the lending activity. The other thing that we're going to see is that it has been a space where we've seen significant growth. And so if we look at the model estimate of total small balance origination volume, what we're going to see here is that in 2009, we were at just about $11 billion. But in 2016, our estimate is $47.6 billion. So over the period, over this relatively short period of time, we've actually seen small balance multifamily lending in the United States increase more than fourfold. But my first question then is both to Ivan and Steve. But Ivan, if you can kick us off, why has there been such extraordinary growth in small balance lending activity?
I think the obvious, which you mentioned, is purely the appreciation in multifamily assets, and that probably accounts for about half of that growth. A lot of the other growth has come from the fact that some of the transactions were perhaps privately financed due to the lack of availability of financing in the space. With Freddie Mac's entrance into the space and some other agencies entering into the space, the standardization has made financing more readily available and has created actual liquidity in that market where it lacked liquidity in the past.
Steve, can you tell us a little bit about Freddie Mac's entry into this space and why it plays such a significant role now?
Sure. So Freddie Mac, we have done, and this is sort of a misnomer, but Freddie Mac Multifamily has been involved in smaller balance loans, as Sam defined, for quite some time. But we were managing them off the side of our desk, and in order to really bring all of our credit experience to bear, all the tools and talents that we have at Freddie Mac, we felt like we needed to create our own business focused on the small balance borrower, the small balance market.
So, Ivan, as Freddie Mac has begun to play a larger role in this space and has developed new programs, it's not the case that a small balance lender, borrower, I should say, would interface directly with Freddie Mac. Can you tell us a little bit about how it is that Arbor works with Freddie in developing the SBL program?
So we've always been very active in the small balance, the small loan space. And I think that has a lot to do with our background coming out of the residential lending area and being able to develop the processes to make it more efficient. Touching back on your last question and relating it to this question, to process loans of this nature, small balance loans, and to do it efficiently and profitably is not easy. You mentioned earlier the number of units that are comprised of small balance loans, that under $3 million is approximately 63% of the market. But what you don't understand is that although it's 63% of the number of units, it's a very small fraction of the overall dollars. So people did not like to do that. Freddie Mac saw the need. They came to us to work with us, and we developed the process, but more importantly, the standardization. Without standardization, then you can't really penetrate the market and be effective within the market. So with Freddie Mac's input and structure, they were able to bring a number of products to the market, create standardization, and create process.
And Sam, if I could just jump in as well, one of the things that was so compelling about this market to us and why we'd wanted to be in it for so long is really in one word, which is workforce housing. It became very clear to us over the course of the last 4 or 5 years, our mission in multifamily at Freddie Mac, in a word, is workforce housing, providing liquidity. All of our skills and experiences were developed around workforce housing. And when you think of workforce housing, you can't think of it without thinking about the small balance world, the smaller property world. We feel like that is where your firemen, your policemen, really the sort of the backbone of the country. That's where they're renting. And at the end of the day, if we are about, and we're honest with ourselves about being about workforce housing and trying to drive liquidity, you have to be in small balance. You just have to. And so we pushed like crazy to enter that market, and our conservators saw the wisdom in that at the end of 2014. And you got to partner with the best to expect the best. And as Ivan mentioned, Arbor has been absolutely instrumental in designing and developing the program along with us.
So could you just elaborate on that for a moment and tell us a little bit about what do you mean when you talk about workforce housing?
Well, that workforce housing, let's be honest, the space, the A space, the B plus space in top markets, there are plenty of folks ready and willing to provide liquidity in those spaces. In the sort of the middle of the country, the areas where the folks are working on the core infrastructure that are actually a part of the fabric of that economy. These terms get thrown around a little bit, but we felt like that was the opportunity to step in, to be able to apply our credit culture, which we've proven time and time again, do it responsibly, do it well, do it economically.
So we're not necessarily here, we're not talking about that urban core, high-rise, Class A, high-amenity property, where in fact the unit sizes may be relatively smaller, and the amenities that tenants would have access to might be sort of what we would think of as luxury amenities, but perhaps not so much sort of access to a good quality public school down the street.
You got it.
Can you give us a bit of an idea? I know that you've talked about sort of the growth in the program, but if we can take a look at the slide SBL program volume, actually just give us a sense of what's the order of magnitude of growth in activity that we've seen?
Well, I think the first thing when you look at this, I think any reasonable person, and I'm looking at Ivan now. Did you expect that, Ivan?
We had no idea that bringing this kind of product to the market would create this kind of momentum and volume.
And I mentioned this before. You have to partner with the best. And partnering with Arbor to design this business was one of the key reasons for this kind of growth. That's the first thing. And the second thing is, as Sam mentioned, we're not in the primary market. We're not lending directly to that borrower, that property owner. So we had to go out and find partners who would originate for us. That is the secondary market that we live in. Arbor is a key player in that. As you'll hear a couple times throughout the slides, they've been the top lender the last 2 years since we started the program, frankly. And when I look to those numbers, what that says to me is we're pretty good at this stuff, but our partners are even better. And I believe that the product we've designed together is one that is specifically put together for today's borrower. And it's also, I think, a really appropriate balance of the kind of borrowers that are out there, whether it be that person in who's has a couple properties in the Bronx or Brooklyn, or that person who's in Hazard, Kentucky. We designed a product that we feel like is easy to understand and a streamlined process that's easy to get up and down. At the end of the day, it's about the best partners, designing the right product for today's borrower.
You know, so Sam, I had a kind of case of deja vu because I go back to my days when I was in law school and I started my residential company, and residential lending was almost in the same place from a securitization standpoint as this multifamily lending. And I was asked the same question on my law school exam, is how would the impact of securitization and creating the right standardization for loan products do for loans? And my answer, and I wrote a couple of blue books on how it would create a lot of liquidity in the market. And by the way, I got a C on that exam. But the same thing applied here. When you created standardization in product and you made that product available in tertiary markets like Kentucky, as you do in the city, you created liquidity and standardization and easy to use. And that's why this product is so successful in the market.
Right. Now, Arbor has been in the small balance space for a long time. As you mentioned, your own experience goes back to the beginnings of your career. Can you elaborate on some of the details of Arbor's participation in this market?
I think that we've always had an affinity to get to know our borrowers, and for us, not being a banking institution, a lot of the small balance borrowers would come in and meet with us and develop a relationship. So we knew their behavior, we knew what they were looking for, and that's why we focused on this segment. And we developed a very loyal and committed sponsorship. These borrowers are also very active. They just don't buy 1 or 2 properties a year. They often buy 5, 7, or 8 properties. So they're looking for a reliable source and a relationship, and that's why this product and the standardization has meant so much to build the momentum.
So when you talk about that borrower perhaps investing in 7 or 8 properties, I think one of the things that our research shows is that there are very real and meaningful differences in terms of that borrower profile. It's not the institutional borrower that is deploying $100 or $200 million to acquire an asset in the urban core. It's a very different investment strategy. It's a different borrower with different needs. Can you tell us, both Ivan and Steve, just a little bit about who is that small balance borrower?
It's very often the individual who knows a submarket. He goes into the submarket, buys a property, manages it, fixes it, and then decides that's going to be his career. Then he buys a second one and a third one. He knows the neighborhood, he knows the tenants, he knows the assets to buy, and he becomes part of that neighborhood, as opposed to the institutional person or firm that goes ahead and buys a 500-unit project and hires a third-party manager. Very different type of borrower.
And I would add to that Ivan already mentioned it. One of the things that actually surprised me in this business around the borrower was I figured it would be widgets. That it would be sort of nameless, faceless widgets that move from here to there. Couldn't have been more wrong. And and certainly the piece that Ivan mentioned around buying multiple properties, this whole idea of portfolios, caught me by surprise. It remains a relationship business. You just got to move a lot faster than you did on the other side, and certainly we've seen a tremendous amount of portfolios. Now, one other thing that I would mention is, and you see the word or words, I don't know how that works, but I failed English, but non-institutional, which to me feels sort of, I don't think it's meant to be. It is what it is, but sometimes it can feel like maybe less sophisticated. You hear that, I got to tell you that the borrowers we have met know their stuff. And as Ivan mentioned, they know those submarkets better than anybody. And the skill that's required to manage these properties in these markets, I'm all I can say is that I'm impressed. Every one of the borrowers I've met has a strategy, short-term and long-term. They know what they're doing.
Yeah. And it's not just the borrower that's different. Steve, you mentioned workforce housing. The people are really the fabric of the economy and the neighborhoods in which we are investing. When we look at the renters as well, that renter profile, is different from what we might see if we were to look at the urban core Class A high amenity property. And I think what's really interesting for people is that while a lot of the discussion around millennials and sort of what amenities they're looking for, tends to focus on the walkability of the downtown core. What we see is that is a subset of millennial renters, and when we look at a much broader population, what we're going to see is that many millennials and many families, particularly young families, are going to live in relatively smaller properties where the amenity set is different. It might not be the amenity that's internal to the property. It could be the resources of the local community that people have access to. And when we're looking at some of that data, for example, the age distribution in small versus large assets, I think it's perhaps counterintuitive or sort of really challenges the conventional wisdom when we see that the age distribution in that smaller property tends to be a little bit younger. And in part what that reflects is that with not as rich an amenity set, in that smaller property, rents tend to be also a little bit lower. These are relatively more affordable properties in an era where rents have been increasing for the multifamily sector overall at a fairly fast clip. The other thing I think we're going to see is that when we look at the composition of the renter families and households, they're more likely to have children. And again, where that fits with the features of the properties themselves, although the properties tend to have fewer units. When we look at the units themselves within those properties, they tend to be a little bit larger. So if you value that second bedroom, the larger living room space, the larger kitchen, on average, you're more likely to find that in the relatively smaller property. We've seen a trend in that high amenity urban core property to actually see unit sizes that have come down a little bit as developers have made trade-offs that have favored the common features of the property and not as much enlarging the unit sizes. Ivan, when you're working with borrowers, what do you see in the renter pool as well?
I think that the rental pool is a little bit different. People don't want to pay for the amenity space. They don't want to pay for the doorman. But what they do want to do is have a little bit more living space. And that's clearly a trade-off. And there are a lot of people who don't want to go into the mega building. They like a small building. They like that hominess. They like that family type of feeling. And even some of these smaller walk-ups, remember, if you're in Brooklyn, if you're in Manhattan, it could be a 12-unit walk-up building, 4 floors with a garden in the back that people have access to. So there's more of a family feeling as opposed to the high amenity, which is, a faster, higher level pace with less living area.
Yeah, and what's interesting about this, and Sam and I were actually talking about this beforehand, it'd be interesting, Sam, to see that cut by sort of our target population, right? So this would include, to the extent there are smaller properties that are sort of A class down to. It'd be interesting to see this information cut towards our portfolio because, as Ivan has mentioned and I've mentioned previously around the types of renters we typically see in our book, when we're out there talking to the folks that are in our business, and we've now funded over 3,000 loans, not too shabby, here in our third year. What we do see in this asset class is the backbone of America. It's those people that are keeping us safe, keeping the infrastructure of the town intact, and so that's what we're seeing. So I know that when you look at this graph, it's a little bit counterintuitive the way I'm describing it. Maybe it's just that the rest of the people up there in green are all policemen, firemen, and nursing techs, et cetera. So you see my point.
So when we're talking about sort of that composition of renters that you see in the properties against which you're providing financing, I guess one of the things I wanted to ask you about is a smaller property in a segment of the market where we've seen recently improvements in liquidity, as Ivan had described. I think for some participants in the market that might imply or they might infer more risk. But when you're talking about this particular renter population, particularly where there's a young family, where it is someone who is serving the community, I guess that also implies, there are good reasons to think that implies stability of income.
I definitely think that there is a lot of stability in the type of renters in these properties. They're not as transient. It's more long-term. There's more space. They get comfortable and they stay in place. By providing liquidity and capital to the markets, I think that the product will be better maintained. There's more capital available, more capital for capital improvements. There are more people interested in buying these assets. So I think overall, with the kind of financing that Freddie Mac has put together, it's going to service this market and provide better housing overall.
Yeah, and I think you mentioned a second ago about putting money back into the property, and indeed what we see is typically with cash outs, with values improving. I think part of that is liquidity and what you're seeing in values improving, markets improving. They're putting money back into the assets. It's absolutely an outstanding thing to see from our perspective and from a credit perspective, to see that your borrowers are taking that money and not going and buying treasuries or doing something. They're putting the money back into their investment property. I mean, you couldn't ask for a better scenario than that. Keeping the collateral clean, keeping it safe, keeping it stable.
So as the next step in our discussion, we're going to step back from small balance for a moment and actually provide a little bit of additional context around sort of what's happening in multifamily overall. And I think what we see when we take a look at sort of state of the multifamily industry, as many of us who are exposed to the residential sector, whether it be multifamily or single family residential, are aware, we have been in a period since the housing boom, since the financial crisis, where tenure has shifted in the United States fairly dramatically. And as this chart shows, we now have more than a decade where home ownership rates have been declining. Some of that has to do with changes in preferences. Some of it may have to do with the availability and ability to qualify for single-family mortgages, the levels of savings that young families that want to transition to single-family homes may have access to. I think a lot of it does have to do with sort of the desire for flexibility that a relatively younger person may bring to their utility function. So we've had this significant decline in homeownership rates that then coincides, as you can see, in that darker green line with a rapid increase in multifamily occupancy rates. Now, we've had a lot of multifamily come online. Not all of multifamily is the same. It's not all in the same place. It's not all the same in terms of its amenity set. And while I think there are certainly concerns about the market's ability to absorb all of that new inventory in some markets and submarkets around the country, overall what we've seen is that the market has done a very good job of absorbing the new inventory that has come online. If we take a look at this next slide, then I think what it shows us is again how that is translating into actual property level outcomes. So when we look at the income capacity, income stability of properties, we now have again a relatively shorter period of time shown here, but a protracted period during which, as tenure has shifted towards renting, we have had increases in rents in the United States, vacancy rates that have declined and have remained below 5%, even as we brought new inventory online. Certainly, I think we're at a point in the cycle where some of that momentum around rent growth has begun to taper off in many markets. But we also see in terms of sales volume and prices that we have, and this is data from Real Capital, that we've had increases over, again, this 5 years, but even longer than this in terms of just sales volume in the multifamily space. So there is that liquidity there, not just in the small balance segment of the market, but overall. In 2016, as compared to 2015, I think the Real Capital data shows that overall in commercial real estate, office, retail, industrial, hotel, we saw year-over-year declines in overall investment activity. And multifamily of the core asset types was the one exception to that, where we had, albeit modest, an increase in transaction activity, which really differentiated it from some of the other property types. Steve, tell me a little bit about that broader portfolio, but then also what that has meant for, what are some of the similarities or differences that might emerge in small balance?
If you were to look over time, look where rates were up, rates were down, what you're going to find is we apply that same credit discipline, that same credit culture. Look, our job is to step in when markets start trending towards illiquidity, right? And so our book is held up. If you look at our overall performance, we are trending in the broader multifamily as well as small balance to be slightly beyond where we were last year in terms of overall production. So I think it's hard to sort of take our book and apply it to the market because we're supposed to be there when the market draws back, right? So I don't know. I think I'm dodging your question a little bit, and you just confirmed I am. I don't know, Ivan, if you have any thoughts on the matter.
What was your question?
Well, I'll tell you what. I actually have another follow-up question.
Maybe
for
you have a better answer.
If we jump to the next slide, I think what we're going to see is that and this piece of it I think is fairly consistent with that larger narrative in the market of a lot of the investment activity, a lot of the new development activity being in those relatively more urban, high-rise, large properties. When we look at the stock of structures in the United States, and we look in particular at multifamily, we've seen some relative declines in the share of the market that is 2 to 4 units, 5 to 19 units, and some of the growth has been in that 50-plus unit space, the relatively larger property that does have that richer amenity set. Perhaps if you could opine on why it is that we've seen more limited growth in that relatively smaller property space, how much of it has to do with sort of issues around liquidity, the availability of financing to actually build?
So I think that, first of all, we got to address the market fundamentals, the macro issue. The macro issue is that home ownership is at the lowest rate it has been since I can remember, and that's all a post-crisis issue. And there's a psychology that people want to rent and not own. It used to be the psychology everybody wanted to own and not rent and build wealth. That has created the demand in multifamily, and those are the fundamentals that we're all operating under. So there has been a decent amount of liquidity for construction and acquisition, and in general, people have taken those dollars, and it's easy to buy a bigger project than a smaller project. And that's why the dollar amount towards the bigger projects are there. With respect to the occupancy numbers and the rent numbers and the growth numbers, that's just a demand and supply factor, right? We went after the crisis to not that many new units being built, but yet a tremendous demand because nobody's buying into multifamily units, and that's continuing. And that's also in spite of the fact that the rents have outpaced wages, and that's unusual. But the demand has been so strong because there's just a lack of home ownership desire.
Right, and that lack of home ownership, the decline in the home ownership rate, of course, is taking place against the backdrop of an environment in which the cost of financing that single-family mortgage has declined dramatically. And so if we take a look at some of those interest rates, I think what's striking about any interest rate chart is, of course, that after the recession of 2001, long-term rates had largely recovered by the time we had hit the peak of the last cycle and the beginnings of the financial crisis. You compare that to what we've seen over the course of this cycle, and of course, so much about this downturn and subsequent recovery has differentiated it from anything that we've seen in our lifetimes. But I think in part where that's reflected is in that interest rates really have not returned to any kind of notion we have around normal levels. Now, I think that after the election, there may have been sort of an anecdotal sense that, okay, we're going to increase the fiscal stimulus, people are getting back to work, higher rates of wage growth, inflation expectations began to increase, but that hasn't translated into a dramatic or radical increase in the interest rate environment. Of course, these broad measures of interest rates don't translate directly into the cost of financing in multifamily. But what have we seen, particularly over the last couple of months, let's say in the post-election period, in terms of the cost of financing, the interest rates we're seeing out there in the multifamily space?
I think what we have seen in talking to a lot of our borrowers, the initial shock and the rise in interest rates was a real shock. But instead of taking a 10-year product, some of our borrowers moved to 7- and 5-year products or to variable rate products to deal with that. But rates settled back down, and that was an adjustment. But there was a very, very big impact on the single-family market. People who were buying homes and relying on financing with mortgages, they lost 25% of their purchasing power. I think that stalled the market, and that had big impact. People couldn't afford, and there was not a corresponding price adjustment on housing, so that market just stalled. And I do believe, to a large extent, that's what pushed interest rates back down. With the stalling housing environment in the United States, it would really slide us back in terms of productivity.
Okay, so as we've seen, some of that stagnancy in the single-family market, Ivan, as you're describing, of course, on the other side of this, we have multifamily markets around the country that are exceptionally strong. And as you pointed out, and of course, this is a policy challenge for us, one that we address in part through providing financing for workforce and relatively more affordable units, that we have had this protracted period where income growth for that median American family has not kept pace with their rent growth, and in the absence of significant discretionary income, folks have had to substitute away from other very important things to pay their rent. But when we look at those multifamily income outcomes, sort of where are we? What do we project will happen in 2017? So I'm seeing here sort of in Freddie Mac's projections, Sacramento has 2017 annualized gross income of 6.4%. I know that Sacramento was amongst some of one of the markets that certainly was impacted by the financial crisis. Now has a 2.2% vacancy rate. The other thing I'm noticing looking at this chart is that there are a lot of West Coast markets here. Sure. Sacramento, Seattle, Tacoma, Portland, our top markets in terms of Freddie's projections really are on the West Coast. Elaborate a little bit on what we're seeing here.
Well, I think, again, you go back to the analytics we see on this slide versus where we're actually lending, right? And so if you see, typically we're going to be in the workforce housing, that's where we're focused. We're continuing to see strong numbers, lots of activity in most markets, that we're in. It's specifically around this idea of workforce housing. People are moving away from, the A-class units. Then they're moving sort of into the sort of target zone for Freddie Mac. I mean, I don't know how to describe it other than that. I mean, it's always difficult when I see these graphs because it includes such a large segment of the market that we're not focused on necessarily. I mean, obviously, if it went illiquid, we could be. We're driven by affordability. We are driven by, providing liquidity. And so when you see these, it's hard to sort of, directly move from these numbers to how we're going to perform. Overall, we're seeing growth. I mean, that's one way to answer it.
Yeah. Ivan, tell us a little bit about where Arbor is most active, particularly in the small balance space.
I think if you go to California, Texas, the Southeast, Florida, and of course New York, these are major areas for us. That's where there's a lot of housing stock in that area. There are other areas in tertiary markets, but the amount of volume on a dollar basis is not there, but we do service those markets as well.
Yeah. When we're thinking then about some of the more specifics, the next section of our deck talks about why pursue small balance financing. And as Ivan described earlier, we've seen significant improvements in liquidity here. There was previously a lot of private capital in this space. When we're looking at sort of the growth in financing through Freddie's programs, tell us a little bit more about the actual terms that people can expect.
Sure. I think you mentioned before sort of the 1 to 6 million nationwide. You talked about from 6 to 7.5 million top and standard markets with 75 units or less. I think that's one of the most important developments, and what that signifies is this realization we've had in we call it small balance, that it's not necessarily about the balance, right? It's about smaller properties, and I almost feel like if we could go back, Ivan, we might have named it differently. We're here, people know what it is, so we'll take our wins and we'll go. But what we found is there's certainly a gap in top markets and standard markets as it relates to smaller properties, and the way that we designed the program was holding us back from providing that consistency Ivan talked about, providing that liquidity that was so important to standardizing the way that this business was conducted. So having that realization and moving those numbers, it also reflected, if you just look at the 1 to 6 million, originally we were at 1 to 5 million, you move up to 6 million, that reflected values, right? So values improved significantly. And if you look at a deal that was a loan that was maybe in a top market in end of 2014, which is when we originally designed this business, let's say it was $4 million. That deal is now exceeds $6 million. And no real investment necessarily in the structure or addition of income-bearing units. So this movement, the most important thing on this particular slide is to understand that we've moved, and this is, in my mind, this is sort of a right sizing of the business so that we can fully get at what the small, sort of, again, go back to workforce housing, we can fully focus on this where we were being held back a little bit in the past. The other thing you're going to see here is, we talked about this a second ago, is simplification. So I'm not going to go through every one of these, but the things that people are interested in, this idea of a hybrid, so a 5-year fixed period followed by a 15-year hybrid period. So this 20-year, 30-year AM kind of construct has been incredibly popular. Our coupon pricing, that reflects this idea that our borrower is probably a little bit closer to a single-family borrower and doesn't need to or want to deal with spread over rates and trying to do all the bells and or the jumping around you got to do to understand that. So coupon pricing, here is your number, that is your rate at the end of the day. And then finally, I would say the step-down prepay. I mean, a lot of products that are out there have yield maintenance. Again, one of these things that on the multifamily side, the sort of the bigger side of things, larger balance, that's a completely understood concept. On our side, less so. And so having that very clear step-down prepay is also very important. I don't know, Ivan, if you see other things you think that you've heard are very important to the program?
I think what's important, and it really goes back to a lot of your questions, is somebody borrowing $30 million, he generally knows the financing that's available, the rates, the terms, what it's going to cost him. What Freddie Mac has done and what Arbor has done is it produced these variety of products and allows somebody who's buying a $3 million property to know with tremendous certainty what the options and what the costs are. And that's a major, major factor. Take a $3 million loan, our entire application fee is $12,500, which covers all third-party reports and legal. It could be that you can go apply at a bank and your legal may be $30,000 or $40,000. So we've narrowed the scope, standardized it, created a variety of products, and that's what we've delivered to the person buying these properties.
So what I want to ask you about in just a little while is what are some of the specific things that Arbor has done in terms of innovation with its platform that have allowed for that streamlining and significant efficiency gains. We've talked about sort of that small balance borrower in terms of the number of units, in terms of the size of the loan, but there are additional additional eligibility criteria, and so could you elaborate on those for us?
Sure, and the way that whenever I've seen this slide put up there, I sort of say, if you've got more yeses than nos, you're probably doing it right. But what this reflects, really at the end of the day, you see the couple of no's there. One is sort of a single family, in our view, phenomenon, and the other, I think, is a little bit more complicated from an underwriting perspective. What this reflects is our credit culture, is this experience we are bringing to bear. It is the experience of our seller in Arbor, and that we are willing to look at. You see these things on a case-by-case basis, but predominantly we're saying yes to lots of things. I think, again, that is about experience. You don't agree to deals unless you fully understand how to underwrite that credit. And we have brought that experience from the conventional side through the downturn, where we had incredible results, incredible resiliency in our portfolio. And so what you are seeing here is a business that's willing to having that conversation with you, willing to understand, get their hands dirty. We are in the markets. We feel comfortable with understanding the story in those markets. I think, again, this goes back to this idea of, is this business widgets or not? Well, what you're seeing here is a reflection of what the business is out there. It is not widgets. It is lots of times there is a story to be heard and to be understood, and we feel like we have the expertise, along with Arbor, who certainly brings a ton of knowledge to bear.
So when you're explaining that, of course, the deals aren't widgets, the properties are not, so that we really sort of get our hands around what is this property? What does it look like? Walk us through some of the case studies over here.
Well, sure. I mean, the first thing you'll see in terms of the pictures is varying, asset types themselves. But I think the thing that I take from this is. This is a reflection of appropriate liquidity. This is when liquidity is working at its best, right? Where you've got an asset, you've got a borrower who understands their property. They're able to present that case, right? Effectively present that case to Arbor, who effectively presents that case to Freddie Mac. We have a product they're interested in, right? That is all working in this scenario. They take that money out, and again, we talked about this before. This is the other side of it, which is sometimes they'll take that cash out because of the value we felt comfortable underwriting to, right? As I mentioned a second ago, but people are taking that cash out and they're putting it back into their existing property. Well, this is the other side of the phenomenon, right? Where they may want to go out and acquire other assets. And this is an example of being able to do that very thing.
So when we've got assets, in this model, Ivan, you described some of those efficiency gains, some of the advantages of working with Arbor in particular, and why it is that Arbor's risen to the top of Freddie's rankings in terms of the size and volume of the partnership. Technology, I think, has played a very clear role in positioning Arbor's business. Tell us first a little bit about what Arbor has done, in particular the Loan Express platform.
So I think this is essential to be effective in this space. It's very expensive and very time-consuming to service these small balance loans. To do a $2-3 million loan, it takes the same labor and resources to do a $30 million loan. So a little over a year ago, we launched Alex, our Arbor Loan Express program, which is the automated online originations platform that allows a borrower to apply online. His loan gets processed online. All the data and communication is online. That has reduced our cost and increased our turnaround time, and has been essential for the borrower to have a very, very efficient experience, and for us to be able to do it in a cost-effective way.
So walk us through a little bit about what that sort of experience looks like.
I think it's very simple. We've standardized the documentation. We've allowed the borrower to go online and apply online, and all the information is submitted online. He's able to track his loan. The loan originations officer is able to track his status, and we know what his loan is doing all the time. All the communication is electronic, and just as importantly, going through the closing process, the documentation is standard. Everything is standardized. There's less to negotiate. There's less to have costs on. ordering the third-party reports. All of that is done electronically. It has cut down the amount of time and cost and communication in the loan process.
So, and when we're thinking about some of those specific benefits of the platform, see an example here is e-signature. Just compare and contrast for me. How does an e-signature platform, or a platform that leverages e-signature, differ from the more traditional way that we'd approach this?
I think it's very simple. When you have an e-signature, you do it online. You don't have to submit a document. You don't have to have an original. You don't have to come in. Everything is done with the loan officer sitting in his office or at his computer, and with the person sitting in their office, and everything is done electronically. You don't have to have meetings. You don't have to have interaction. It's submitted, it's queued in, and it's just done on a normal course of business without meetings and phone calls.
So I've known Ivan now for probably almost 3 years. You're not going to invest in anything that doesn't make a ton of sense and doesn't have a return, period. I know that about you. And the reality is that the multifamily business hasn't evolved all that much as a process for a really long time, right? The single-family side has figured it out predominantly on the other side of the fence, right? Alex, and the investment in technology in multifamily has the greatest opportunity to run these loans through quickly. It is the crumb business. A friend of mine told me that. Investing in technology infrastructure in a business that really is a step-by-step process at this point is the right move, and it's already paying off, I'm sure.
I think you have to add one other factor, is it may take a little time to get the borrower acclimated to the online system. But remember, this is not a one-time borrower. It pays off on the second, third, fourth, fifth, sixth, and seventh transaction. And it also allows them to track them all at the same time. So it's not like somebody doing a $30 million loan. This guy's doing 10 $3 million loans. And just one other factor, it used to be break even for us to do a $3 million loan. Mm-hmm. I think we moved down our break even to like $1.7 million just through the online system.
You're making money now. We have to look at those fees.
Not that much, just a little bit.
Well, given the comparison you made, it sounds like a lot of those savings that you've realized are being passed on to the borrowers when they use your platform. For someone on the call who is new to this, they haven't bought that first property. Where do they get started?
They just dial in. They'll get a live person at the end. They'll be walked through the process to get acclimated. And the nice part about Arbor is there's always somebody to talk to. It's not like getting on a screen, getting frustrated, and then walking away. You can access our people. We'll walk you through it. We'll train you. We'll hold your hand, even if it takes your second or third loan. You'll get there because we're committed to get you there, and it makes sense to get you there, but we will have our people available.
And if I would just add on to that, I think listen to these guys. When you make that phone call, listen to them. They have done significant numbers of loans, thousands and thousands of loans. They understand. They're part of building the Freddie Mac product. So listen to the advice you get, because these guys know how to get deals up and down, know how to deliver value, and will get it done in an incredibly short cycle time. So listen to your professional at Arbor, have your story together, and get ready, because it goes awfully quick if you want it to.
I want to make sure that we get to some of the questions that the participants in today's webinar have brought to us. Steve, first one is for you. The small loan market was traditionally served by banks. Freddie, very clear in the data, has made a big move into this space over the course of the last couple of years. What's been the reaction in sort of that competitive market?
Angry would be maybe one way of saying I'm kidding. They're not backing away. I don't think we expected that, did we? I think they have basically doubled down their interest in this business, and certainly with rates the way they were, this was a business where they could find a little bit of yield, right? And so when we stepped in, they upped their game, and they've been in this business a long time. There's certain names that everybody knows that have been doing this a very long time, know how to do it incredibly well. So my perspective, again, if you think about Freddie Mac's role in trying to support workforce housing, trying to think about, as a public policy matter maybe, if I'm allowed to say that, the renter by stepping in and creating competition, I'd like to think, Ivan, you can tell me if this is wrong or not, that we've made everybody maybe a little bit better. We've made everybody step up their game a little bit on the other side of this and the other sort of lending sources. I don't know what your perspective is.
Definitely improve liquidity and the availability of financing, which is translating into better housing stock. There's money now for capital improvements. There's more investor interest. You've made the local guy have the ability to buy multiple properties very easily.
So you mentioned sort of your capital improvements. One of the questions from participants, can this model be used to finance new ground-up development, or is that going to be an entirely different product that they want to look at?
Right now, Freddie Mac and Arbor, we're not offering construction lending for this type of product. There have been some discussions about that, but there's nothing imminent on that.
And with regard to those particular criteria, Steve, you mentioned that at one point it was $1 to $5 million as your upper bound. That's moved in some markets to 7.5. One of our listeners has questions about whether or not there are differences in criteria or upper limits depending on the market you're in particular on a per unit basis.
Per unit basis, no. However, as we've been talking about, I think the spiritual intent of this thing is on those deals that we feel comfortable. This is sort of the sniff test, but we feel comfortable putting out there on the Madison Square Garden, where we feel comfortable knowing what the purpose of our business is, to put that out there and put it in bright lights. This is a deal that we did. And that might sound odd, but that is the sniff test for us. We are about workforce housing. And if we see a deal come in that's maybe it's very new and it's shiny and there's plenty of liquidity around it, we're probably less inclined. We may have a bid on that deal, but based on the competition for that asset, we may or may not be the winner at the end of the day. You don't want to build a program that picks and chooses its spots. We try not to do that. I think we try to think about our mission. Every deal is different, and that's the only way we think of managing. So the answer is no. We don't have specific sort of markers around that. But again, the spirit of this business is workforce housing, and what I would say is that the higher end of $1 per unit would be not in the right spirit.
From the time I pick up the phone to the time I'm closing my loan, what kind of timetable are we looking at?
I think traditionally it used to be 60 to 90 days. I would say we're comfortable giving a 45 to 60 day turnaround time from the time that you are ready to apply to the time that you're ready to close.
And I think that I don't think either of us are yet happy with that. I think a lot of that comes from what's required on my end of things, on Freddie Mac's end of things. And in our third year, we're getting better, and we're going to continue to get better with Ivan and Arbor's feedback. But that's about right. The other thing I would mention, though, is that I don't think there's been an instance yet when Arbor or any of our sellers have brought us a loan and said, we need to get this up and down in X number of days. When you have a motivated borrower, that's the most exciting thing for us. You have a motivated borrower trying to acquire a property by the end of the month. Can you do it? We love that kind of pressure. We love that kind of opportunity. I don't want anybody thinking that there isn't that kind of a turbo path, because we jump to, especially if those are the kind of assets we're interested in.
I think the expectation for normalcy is a 45 to 60 day process. Mm-hmm. Can we get it up and down in 30 days? Yeah, we have. In the right circumstances, we will. But the normal expectation is 45 to 60 days.
That's right. Now, we've talked a lot about sort of the requirements in terms of what the property looks like. One of the participants in today's call has a question about whether or not there are particular requirements around the borrower. Do I, in formal terms or practical terms, need some net worth? Do I have to be an accredited investor? What does that look like?
Yeah, your net worth would be equal to the loan amount, and then the liquidity would be 9 months of amortizing debt service before and after origination. So there is very specific requirements about that. And then we have other requirements around foreign guarantors and things like that, which we don't need to get into here, I don't think.
Sure. Well, what do down payments look like? What is the equity in?
Well, we're running at top markets. We're doing a 120/80, so there you go.
80% loan to cost and a 120 coverage.
Right. As a closing thought, your prognosis for the small balance market in 2017?
What do we say about that, Ivan? We were just talking about that, and maybe your projection first. Let's talk about maybe your book and what you think, where I think I'm going to be, and then maybe we'll do reverse. I'll do the same.
So, I mean, the numbers are astronomical.
Yeah.
I mean, last year, I think we did close to $1 billion, which was well in excess of what we anticipated. I think we're at a pace of almost 30% higher. We could do $1.5 billion to $1.8 billion in small balance loans. That's an enormous number of units. It's probably close to 500 units.
That's right.
That's more than the biggest firms handle. So it's a lot of units, it's a lot of volume, and I think as I was talking to Steve, we're pretty consistent. That represents about 30 to 35% of the overall volume that Freddie Mac does in this space. So we're dominant as a firm, and we're also their biggest partner.
And one of the things I'm sort of not sure of when we talk about market and market size, and as Ivan said, there's been a lack of liquidity across the company, or excuse me, the country. This is a nationwide program. I sort of wonder if we've gotten to every one of those markets yet. My answer to that is no. So I wonder if the overall market doesn't have some more growing to do. I would think that it probably does. Every time we go out to conferences, every time we go to markets, and we'll partner with Arbor, our sellers, to go do that, we're breaking new ground. New brokers, new borrowers who weren't as familiar about this as we would have hoped they'd be by now. But that to me feels like opportunity. So I think hard to say if the total pie is going to get any bigger. My instinct tells me it could get slightly bigger, certainly. But for our business, we started in 2014 at the end of the year, so that was a bit of a wash. 2015, we did $2.7 billion. That was 1,000 loans. That was a massive undertaking. And if you remember, we did most of that from May until the end of the year. It was a big push towards the end of the year. 2016, we rolled up to $3.7 billion. And as I've mentioned, just an extraordinary year. Think about the number of loans, 1,500 loans, something of that nature, 1,600 loans. This year, we are tracking over $6 billion. And just to put that into perspective, that's another 2,200, 2,500 loans. That is a significant pull. It's a significant chunk in the market. And frankly, as long as the sort of economics stand up and we continue to have success in the way that we've positioned and the product, there's no reason why we couldn't do even further than that, $6.5 billion and beyond. So I think as a market, and certainly for Arbor and for Freddie Mac specifically, it's going to be an outstanding year.
And we're rolling up on the hour. I know we have a number of questions that we have not been able to get to. If you'd like to chat with us about that, chat with Arbor about that, please do reach out to our hosts at Arbor. As a closing point, I'll mention, Ivan has talked quite a bit about the improvements in liquidity and functioning of the market. I think an important element of that has been our bringing additional transparency to the market in terms of research that's helped us to understand the dynamics of small properties in a way that we haven't before. My firm works with Ivan's to produce some of this research. We will have our Q1 2017 small balance trends report coming out just next week, where we'll be able to tell you a little bit about what's happened with cap rates, what's happened with debt yields on small balance properties. And again, I think one of the crucial things for us is in continuing to analyze and develop the market's understanding of how these properties are different. It's a different renter, it's a different borrower, and some of the performance trends that we'll see for smaller properties also will differ from what we see from that broader market. So again, thank you to everyone for joining us for today's webinar. We hope to chat with you again soon.